Welcome back, astute investors and curious minds, to another deep dive into the fascinating world of how to borrow stocks and potential short squeeze candidates. Today, we're peeling back the layers on a very specific and intriguing microcap company that is fast on our radar. Get ready, because we're talking about NCT Cayman Limited, ticker symbol NCT. We'll break down why this marine shipping and industrial stock is experiencing an astronomical cost to borrow and what that could mean for its price action. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/stock chart for NCT. Let's get straight to it. NCT Cayman Limited, or NCT, operates in the industrial sector, specifically focusing on marine shipping services. Through its subsidiaries, NCT provides time charter and vessel management services globally, primarily out of Hong Kong. Interestingly, they also have operations in the processing of pulp, paper, and paperboard products. This is a microcap company, meaning it has a relatively small market capitalization, which often contributes to high volatility and unique market dynamics. Show price chart. Looking at the recent price action for NCT, it's been trending upwards. Today, the stock is up plus 2.86%. Over the last 5 days, we've seen a plus 6.51% increase, and extending that to the last 30 days, NCT has climbed an impressive plus 15.76%. Highlight volume data. Now, let's talk volume. Today, NCT traded 593,493 shares, which is actually a bit below its 30-day average volume of 779,606 shares, giving it a relative volume of 0.8x average. Still, for a microcap, this level of trading can be significant. What is cost to borrow and why it matters? So, why is NCT on our hard-to-borrow screener? To understand that, we need to talk about what cost to borrow, or CTB, actually means. When someone wants to short sell a stock, they first have to borrow shares from an existing shareholder, usually through their broker. They then sell those borrowed shares, hoping the price will drop so they can buy them back at a lower price, return them, and pocket the difference. But borrowing isn't free. There's a fee, an interest rate essentially, that short sellers pay to hold those borrowed shares. This is the cost to borrow. Geographic CTB explanation. Why does it matter? A high CTB indicates that there's significant demand to short a particular stock, coupled with a limited supply of shares available to borrow. It's a basic supply and demand equation. For short sellers, this fee is an ongoing expense that eats into their potential profits, and if a short position goes against them, it adds insult to injury. And yes, these fees can absolutely exceed 100% annualized, especially for hard-to-borrow microcaps like NCT. That means for every year a short seller holds the position, they could theoretically pay more than the stock's value in just borrowing fees alone, though these are typically charged daily. Why the stock is hard to borrow right now. Display NCT CTB 677.5%. Now let's bring it back to NCT. Our data shows that the annualized cost to borrow fee for NCT Cayman Limited stands at a staggering 677.5%. This is an extremely high number and a flashing red light for anyone looking at short squeeze potential. We don't have current data on the exact shares available to borrow, but given the CTB rate, it's highly likely that supply is incredibly tight. A major contributing factor here is NCT estimated float, which is a tiny 0.3 million shares. The float represents the number of shares readily available for trading in the open market. When you have such a small float, any significant interest from short sellers creates immense demand for a limited supply, naturally driving up the cost to borrow. Our internal composite squeeze score, which combines factors like CTB level, CTB momentum, shrinking borrow supply, float size, volume/price momentum, and technical setup, gives NCT a score of 42.5 out of 100. This is a moderate score, suggesting that while the conditions are ripe for some movement, it's not an extreme setup yet. It's crucial to remember that a sky-high cost to borrow, even for a stock like NCT, does not automatically guarantee a squeeze. It can also signal that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to maintain their positions. Always consider both sides of the coin. Squeeze mechanics explained. So, how does the short squeeze actually work? Imagine our short sellers on NCT paying that 677.5% CTB. A short squeeze occurs when the price of a stock begins to rise, putting pressure on short sellers. As the price goes up, their paper losses mount, and a high CTB fee continues to accrue. At a certain point, the pain becomes too much, and they are forced to cover their short positions. Covering means buying back the shares they initially sold. Show graphic, squeeze cascade. This forced buying creates a cascade effect. As short sellers buy back shares, it pushes the price even higher, which, in turn, forces more short sellers to cover, further accelerating the price increase. Given NCT minuscule 0.3 million share float, if enough short sellers start covering, the demand for shares to buy back could quickly outstrip the available supply, leading to rapid and dramatic upward price movement. A shrinking supply of borrowable shares simply adds fuel to this fire, making it harder for new shorts to enter and forcing existing shorts to find shares where they can. Dilution risk check. One critical factor to consider when evaluating any potential short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding. This typically happens through offerings like S-1, S-3, or 424B filings. For a short squeeze, dilution can be a killer. Why? Because it increases the float, adding more supply to the market. This extra supply can be bought by short sellers to cover their positions, effectively negating any buying pressure and potentially sending the stop price lower. Display dilution check for NCT. For NCT, our check found good news on this front. There have been no recent dilutive SEC filings such as S-1s, S-3s, or 424Bs in the last 90 days. Additionally, we found no recent reverse splits for NCT in our look-back window. This low dilution risk is a positive sign for any potential short squeeze thesis, as it means the company isn't currently adding significant new supply to the market that could ease short covering pressure. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, if you're watching NCT, what should you keep an eye on? Show live data feed/chart with indicators. First, continue to monitor that cost to borrow fee. If it remains elevated or even climbs higher, signals increasing pressure on short sellers. Second, watch for any updates on shares available to borrow. If that number gets even tighter or disappears entirely, it's another strong indicator of a buying squeeze. Third, pay close attention to volume. Significant increases in buying volume, especially on green days, could signal the start of a squeeze. NCT current relative volume is 0.8x average, so a sustained move above its 30-day average volume of 779,606 shares would be noteworthy. Fourth, look for sustained upward price momentum beyond its recent plus 15.76% in 30 days. Technical breakouts above key resistance levels could act as triggers. Finally, keep an eye on any company-specific news related to NCT Cayman Limited's marine shipping contracts or pulp/paper operations. Positive developments could serve as catalysts to initiate buying pressure. Show NCT chart. In summary, NCT Cayman Limited, NCT, is a microcap industrials and marine shipping stock with an incredibly high annualized cost to borrow of 677.5% and a tiny estimated float of just 0.3 million shares. These are the ingredients that put a stock on our hard-to-borrow screener, giving it a moderate composite squeeze score of 42.5. With no immediate dilution risk, the stage is set for potential volatility. While high CTB offers compelling insights, remember the risks inherent in micro-caps and the fact that short squeezes are never guaranteed. Always conduct your own thorough due diligence. If you found this breakdown of NCT insightful, please hit that like button, subscribe for more deep dives into hard-to-borrow stocks, and let us know in the comments what other tickers you'd like us to analyze next. Until then, stay safe out there and happy trading.